Welcome everyone to this WisdomTree fireside chat. Today we will talk about digital assets and their role into a multi-asset portfolio. I'm very happy to be joined by Dovile Silenskyte and Blake Heimann to discuss this topic. So let's start straight away. Over the last 15 years, digital assets have moved from niche, right, to mainstream. Can we really say now that the institutional adoption has really started?
Yes, absolutely. It has not only started, it's happening. Institutional investors have started to recognize that having small allocation to digital assets within their multi-asset portfolios improves risk and return profile of those portfolios. And in addition, after Bitcoin and Ethereum exchange-traded products were listed in key developed markets all around the globe, now those investors are able to access these exposures via investment vehicles that they are familiar with. Those vehicles plug in easily into their existing risk and accounting systems, and they are just a normal component of their multi-asset portfolio. And we expect that this institutionalization will continue and grow even more over the coming months.
Despite all this, it still feels to me like the default position for most investors, or at least institutional investors, is still 0%, right? That they're still not invested. Is that really how you think investors should think about digital asset allocation, or do you think that something has to give?
Nowadays, most of the investors want to be market neutral. For an investor to be market neutral with respect to digital assets, they need to have approximately 1.5% allocation to digital assets within their portfolios.
It's worth highlighting the investment exposure that this really captures. It's an interesting type of asset class digital assets are. They have both this, I'll say, diversifier-like nature. They have relatively low correlation amongst the other assets in the multi-asset portfolio. So relatively low correlation to equities, commodities, especially when you are looking over the longer period of time. But combined with that, they also have this very strong growth profile, particularly when you look at history. For example, just looking at Bitcoin over the last 10 years, it's outperformed all other asset classes in 7 of those years. Now, it's worth noting that there is some cyclicality that's very much intertwined with, I'll say, the code of Bitcoin itself, but it is interesting to have the opportunity to invest in an asset that has low correlation while still having this growth-like nature to really round out that portfolio exposure that you mentioned.
And as Blake says, Bitcoin has had quite strong performance during the past many years. And since Bitcoin is the key cryptocurrency, when it performs well, it lifts up the other cryptocurrencies as well. So the whole market benefits from strong performance by Bitcoin. And Bitcoin as a very uncorrelated asset, it's a good addition to the portfolios because its high volatility and low correlation to traditional assets results in improved risk and return profile of those portfolios. And for investors, to have 0% allocation to digital assets is an active underweight. And of course, any investor is free to make a decision to actively underweight a specific asset class. For example, investors are free to underweight US equities or European equities, but when doing so, they need to have proper investment thesis. So now, 0% allocation to cryptocurrencies is not a neutral decision.
So, assuming that investors agree with you and start allocating 1.5% to digital assets in their portfolio, should they concentrate more on the large cap like the Bitcoin or the Ethereum? Or do you think they should look at a more diversified basket with more digital assets, basically?
While most investors who have gone into crypto market have gone with Bitcoin or Ethereum, because those are 2 crypto mega cap names, for investors that have not started making the 1.5% allocation within their multi-asset portfolios, going with crypto basket may be a more sensible approach, because going with crypto basket will help them ensure that they will end up holding the winners of this industry. So when you think about crypto basket, you can think about it in the same manner as equity investment, where you go with S&P 500 portfolio. There, you make one investment and you do not have to identify equity securities that will perform well over time. So the same approach can very much be taken for crypto exposures.
And the beauty of this all is that even with the stage we're at, which is still relatively early, there's still enough products out on the market to give you not only that basket exposure, but also the single asset exposure that is quite narrow at this stage, but is growing in terms of the overall offering, which allows investors to really pick and choose how they want to construct that sleeve within the multi-asset portfolio that is expressing their own views on this new digital asset class. So the exchange traded product vehicle is just a very convenient way to do that. It's efficient, it's straightforward in terms of the custody, having to not manage the type of risks involved with managing your own private keys, and you can trade it day in and day out to adjust your portfolios as you see fit, given your risk tolerance. So it's really a nice way for institutional investors to gain access to the space.
Thank you, both of you, for being here. It was really eye-opening.
Thank you.